Hello, friends. I want to ask you a direct question. Did the government just give you $6,000 and you didn't claim it? Because for most Americans 65 and older, the answer is yes. On July 4th, 2025, a new law was signed that added a brand new $6,000 tax deduction specifically for people your age. It applies to your 2025 taxes, the return you filed this year, and it applies again for 2026, 2027, and 2028. $6,000 per person. $12,000 if you are married and both spouses are 65 or older. And according to the Council of Economic Advisors, approximately 33.9 million seniors qualify. 33.9 million. The average benefit is $670 more in after-tax income per eligible taxpayer. But here is the problem. Because this law was signed in July of 2025, after many people had already been thinking about their finances for the year, millions of seniors either do not know it exists, filed their taxes without claiming it, or do not understand whether they qualify. My name is Linda Marsh. I have spent 13 years as a certified financial counselor working exclusively with Americans navigating retirement. And in the past several months, this deduction has come up in almost every single conversation I have had. Today, I am going to explain exactly what this deduction is, who qualifies, how much you can actually save, what happens if you already filed without claiming it, and 3 planning strategies that can help you get the maximum benefit over the next 3 years before this deduction expires. Let us start with what this actually is. The new deduction comes from a piece of legislation called the One Big Beautiful Bill, which was signed into law on July 4th, 2025. It created a new additional deduction of $6,000 for taxpayers who are age 65 or older by the last day of the tax year. That means if you turned 65 on or before December 31st, 2025, you qualify for the 2025 tax year. This is not a tax credit. I want to be very clear about that distinction because people confuse them. A tax credit reduces your tax bill dollar for dollar. A deduction reduces your taxable income, which then reduces your tax bill based on your tax bracket. For someone in the 22% tax bracket, a $6,000 deduction saves approximately $1,320 in federal taxes. For a married couple where both spouses qualify, that is a $12,000 deduction, approximately $2,640 in tax savings at the same bracket. These are real numbers, real money, and the deduction is available whether you itemize or take the standard deduction, which means almost every senior qualifies, regardless of their situation. Now let me walk you through the income limits, because this is where some people get confused. To claim the full $6,000 deduction, your modified adjusted gross income must be $75,000 or less if you are a single filer, or $150,000 or less if you are married and filing jointly. If your income is above those thresholds, the deduction does not disappear entirely. It phases out gradually. Single filers can still claim a reduced deduction up to $175,000 of income. Joint filers up to $250,000. Only above those upper limits does the deduction phase out completely. So let me be clear about who this covers. If you are 65 or older and your household income is under $150,000, you almost certainly qualify for at least part of this deduction. That is the majority of retired Americans. Let me show you what this looks like in real numbers. Take a 72-year-old woman living alone. Her income for the year is $70,000, a combination of Social Security, a small pension, and some IRA withdrawals. Under the old rules, she could claim the standard deduction of $15,750 plus the existing additional senior deduction of $2,000. Total deductions, $17,750. Taxable income, $52,250. Under the new rules, she adds the $6,000 senior deduction on top. Total deductions, $23,750. Taxable income, $46,250. That is $6,000 less of her income being taxed. At the 22% bracket, that saves her $1,320. For a married couple where both spouses are 65 or older with a combined income of $120,000, the math doubles. $12,000 in additional deductions, approximately $2,640 in federal tax savings every year for 4 years, 2025 through 2028. Now I want to address something that several of my clients asked me about immediately when this law passed. They said, "Linda, I thought Congress was going to eliminate taxes on Social Security entirely. Is this the same thing?" No, it is not. The proposal to fully eliminate federal taxes on Social Security benefits did not make it into the final law. What passed instead is this additional deduction. For many lower and middle-income seniors, the effect is similar. The deduction reduces overall taxable income enough that the amount of Social Security subject to tax drops significantly or disappears entirely. But it is not a full elimination of Social Security taxes. It is a deduction that can dramatically reduce your overall tax burden, including on Social Security income. I want to make sure you understand the difference, because there has been a lot of confusion and some misleading information circulating about what this law actually does. Now let us talk about something very important. What if you already filed your 2025 taxes and did not claim this deduction? This is more common than you would think. The law was signed in July 2025, and many tax preparation tools and advisors were not fully updated immediately. Some seniors filed before the guidance was fully clear. If you filed your 2025 return and did not claim the senior deduction, you can file an amended return using IRS Form 1040X. An amended return allows you to correct a previously filed tax return and claim deductions you missed. The IRS generally allows amendments within 3 years of the original filing deadline. This is not complicated. If you used a tax professional, call them and ask whether the senior deduction was included on your return. If it was not, ask them to file an amended return. Most tax professionals can do this relatively quickly. If you filed yourself using software, log back into your account. Most major tax software programs have already been updated and will allow you to amend your return and claim the deduction. I had a client named Barbara from outside of Charlotte, North Carolina. She is 68, retired, and had filed her 2025 taxes in February before she heard about this deduction. When we reviewed her return, the deduction had not been included. Her income was $63,000. She was squarely in the qualifying range. We filed an amended return. The IRS processed it in approximately 8 weeks. Barbara received a refund of $1,140. One phone call, 8 weeks, over $1,100 back. Check your return. Now I want to spend some time on the planning opportunity that most people are completely missing. The senior deduction applies for 2025 through 2028. That is 4 tax years. For a married couple where both spouses qualify, that is potentially 4 times $12,000. $48,000 in additional deductions over 4 years. At the 22% bracket, that is over $10,000 in total tax savings. But here is what makes this even more valuable and what most people do not realize. The deduction is not just for Social Security income. It applies against any type of income: pension income, IRA withdrawals, investment gains, rental income, part-time work, everything. One of the best financial advisors I know described this as a 4-year window of opportunity to restructure how and when you take income from your retirement accounts. Here is what I mean. If you have a traditional IRA or a 401k that you have not started withdrawing from yet, the next 4 years represent an unusually good time to take larger withdrawals, up to the phase-out threshold, because the deduction shelters more of that income from tax. Similarly, if you have been thinking about a Roth conversion, moving money from a traditional IRA to a Roth IRA, the next 4 years are particularly advantageous because the senior deduction reduces the taxable impact of those conversions. I want to be careful here to say that every situation is different, and you should work with a tax professional or financial advisor before making any significant changes to your withdrawal strategy. But the general principle is real. This deduction creates a window of reduced taxation that expires in 2028, and the people who plan around it will be meaningfully better off than those who simply claim the deduction and move on. Let me tell you about another client. His name is Richard, and he is from outside of Tampa, Florida. He is 67, married, and his wife is also 65. When this law passed, Richard called me. He said, "Linda, my accountant just told me about this deduction. We are going to save about $2,500 a year on taxes. That is great." I said, "Richard, that is wonderful. But let me ask you something. Do you have a traditional IRA you have not started drawing from yet?" He did, about $400,000. I said, "Richard, you have required minimum distributions starting at age 73. When those kick in, your income is going to jump significantly, possibly above the phase-out threshold for this deduction. But right now, for the next 6 years, your income is lower." We worked with his tax professional to develop a Roth conversion strategy. Over the next 3 years, while the senior deduction is still in place, Richard is converting a portion of his traditional IRA to a Roth each year. The senior deduction shelters part of the tax cost. When required minimum distributions begin at 73, the converted money is already in the Roth, where it grows tax-free and is not subject to RMDs. Richard's estimated total tax savings over the next 15 years from that conversation, over $42,000, all starting from a $6,000 deduction. This is why I always say that the difference between retirees who come out ahead and those who leave money on the table is almost never one big decision. It is whether they had the right information to make several small decisions correctly over time. The deduction is the starting point. What you do with the window it creates, that is where the real planning happens. Now let me give you your complete action list for this topic. Number 1, confirm your eligibility. You must be 65 or older by December 31st of the tax year. Single filers with income under $75,000 receive the full deduction. Joint filers with combined income under $150,000 receive the full deduction. Partial deductions are available above those thresholds up to $175,000 single and $250,000 joint. Number 2, check your already filed return. If you filed your 2025 taxes and did not claim the $6,000 senior deduction, contact your tax preparer or log into your tax software and ask about filing an amended return using Form 1040X. Do not assume it was included. Verify. Number 3, plan for 2026, 2027, and 2028. This deduction is available for 4 tax years. If you have flexibility in how much income you take from retirement accounts, work with a tax professional to use this window strategically. Number 4, consider a Roth conversion. If you have a traditional IRA and your income is currently below the phase-out thresholds, this 4-year window may be an excellent time to do partial Roth conversions. The senior deduction reduces the tax cost of converting. Number 5, do not assume this will be extended. The deduction is currently scheduled to expire after the 2028 tax year. Plan as if it will end on schedule and treat any extension as a bonus. Number 6, if you are married and only one spouse is 65 or older, you still qualify, but only for $6,000, not $12,000. If your spouse turns 65 before December 31st of any year in this window, you may become eligible for the full $12,000 deduction for that year and beyond. 33.9 million Americans qualify for this deduction. That is a remarkable number, and I genuinely believe that a significant portion of them either do not know it exists, did not claim it correctly on their 2025 return, or have not thought through the planning opportunities it creates for the next 3 years. That is the gap this video was meant to close. You worked for decades. You paid taxes your entire career. This is one of the few times in recent memory that Congress specifically created something designed to reduce your burden, and it is real, it is currently in effect, and it expires in 2028. Do not let it pass without claiming every dollar it gives you. If this video was helpful, please leave a comment below telling me whether you knew about this deduction before today. It genuinely helps other people in the same situation find this information. I will see you in the next one.